It is Saturday, January 24th, 2026. And if you've been glued to the charts this week, you know the market is doing that thing.
That thing where it can't decide if we're going to the moon or, the center of the Earth.
Exactly. It's been a wild ride. But while everyone is analyzing one-minute candles, we're going to look at something else entirely. We're looking at the plumbing.
The plumbing is almost always where the real story is. I mean, it's not the fancy countertop that matters. It's that the pipes don't burst.
That is a vivid image to start with. But you're right. Today, we're doing a deep dive into Chainlink. And look, before you say, oh, the Oracle coin, I know about price feeds, boring.
Yeah. Hold on.
Hold on a second. Because looking at the stack of sources we have today, and it is a thick stack, this is not the Chainlink of 2021 or even 2024.
No, definitely not. I mean, if you haven't looked at this infrastructure layer in the last year, you are operating on old firmware. We're looking at a fundamental shift.
What have we got?
We have technical updates on something called the Automated Compliance Engine. We have a voluntary regulatory filing with European authorities that's surprisingly revealing.
And then there's a big one.
And a heavy-hitting working paper from the NBER, that's the National Bureau of Economic Research.
For anyone who doesn't know, the NBER isn't some crypto blog. These are the economists who officially declare when a recession starts and ends.
They are serious people, exactly, and they're analyzing the actual economic impact of oracles. Plus, we've got news about U.S. equities going on-chain.
So the mission for today is to unpack how Chainlink is transitioning from just a crypto tool to what looks like a global standard for that $80 trillion traditional finance market.
And we have to ask the hard question. Is the boring infrastructure play finally paying off?
Let's get right into it. I want to start with a number that literally made me stop scrolling. I was reading through these reports, and they highlighted Chainlink's cross-chain interoperability protocol CCIP. They said transfer volumes surged by 1,972% annually.
Almost a 2,000% increase.
Reaching $7.77 billion. Now look, in global finance, $7 billion might not sound huge, but that growth rate is just vertical.
It's the trajectory that matters. But to understand why that number is such a big deal, you have to remember the context. You remember the bridge wars of 21, 22?
Oh, vaguely. I mostly remember a lot of headlines about hacks.
It was a total disaster zone. Bridges, the tools letting you move a token from Ethereum to Solana or wherever, were just getting looted constantly. We're talking Wormhole, Nomad, billions of dollars just vanished. Cross-chain was the most dangerous neighborhood in crypto.
So fast forward to now, 2026. This huge surge in CCIP volume isn't just people moving money for fun. It's a flight to safety.
It's the market choosing a standard. And the biggest signal here isn't just the volume, it's who is moving that volume. I mean, look at Coinbase.
Right. The sources mentioned Coinbase selected CCIP as the exclusive bridge for all their wrapped assets. So, CBBTC, CBE.
Think about the risk profile of a public company like Coinbase. They're under a microscope. If they build their own bridge and it gets hacked, their stock goes to zero.
Okay.
If they pick a third-party bridge and it gets hacked, they're liable. So for them to outsource that critical piece of infrastructure to Chainlink, it effectively says, we trust this code more than anyone else's.
And maybe even more than we trust ourselves to build it.
Precisely. It's a massive endorsement. And it's not just them. Lido upgraded to CCIP for their wrapped staked ETH.
Which is a $33 billion asset.
A huge asset. So you have the biggest exchange and the biggest DeFi protocol both consolidating onto this one rail.
It reminds me of a Reddit thread I saw while prepping. The community, who can be a bit dramatic, they were calling it one chain to link them all. But looking at this, it feels less like a meme and more like, well, the glue of the internet.
That's the right analogy. Chainlink isn't trying to be the next killer app. It's trying to be TCP/IP, the layer that connects Ethereum to Solana and all of them to the banking system.
Okay, so the pipes are laid and the water is flowing. But pipes are useless if you don't have anything valuable to put through them. And that leads me to the most confusing but seemingly important part of the research, the Chainlink Runtime Environment, the CRE.
Ah, yes, the CRE.
It sounds like something from a sci-fi movie. It launched back in November of 25. Break this down for me. Why does a runtime environment matter?
Okay, think about the early internet. If you wanted to build a website, you had to manage your own physical server in a closet. It was messy, expensive, hard to scale.
You're right.
Then came the cloud, AWS, Azure. They gave you a unified environment where you could just deploy code, and it worked.
So CRE is the AWS for crypto.
In a sense, yeah. Before the CRE, If a bank like UBS wanted to build a smart contract that used data from the NYSE, executed a trade on Ethereum, and then settled on their private ledger.
It's a mess.
A total nightmare. You're stitching together 4 different technologies. The CRE is that universal orchestration layer. It lets them write code in one place that just interacts with all those chains and data sources at the same time.
It lowers the barrier to entry.
Dramatically. It moves the whole conversation from how do we even build this to, okay, what should we build?
And what they're building brings us to secrecy, or I guess the corporate term is privacy. The tech briefs kept mentioning confidential compute.
This is arguably the most critical piece of the whole puzzle.
But wait a second. I thought the whole point of blockchain was transparency. Don't trust, verify. Everything is public. Why are we suddenly trying to hide things?
Because you aren't JP Morgan.
Fair point.
I mean, imagine you're a massive hedge fund. You spend millions developing a proprietary trading strategy. If you execute that on a public blockchain, every single one of your competitors sees exactly what you're doing. In real time.
They'll front run you. They'll copy you. Your edge is gone.
Instantly. So for them, transparency is actually a bug, not a feature. Institutional finance needs its dark pools, its private order books. They need privacy. Confidential compute lets them use the public blockchain for the final settlement, the receipt, basically, while keeping all their business logic, their secret sauce, completely hidden.
So they get the security of the blockchain without showing their whole hand.
Exactly. One user called it the last missing piece, and I think they're right. Without privacy, you get zero institutional adoption. With it, the floodgates can finally open.
Speaking of floodgates, let's talk about that $80 trillion elephant in the room, TradFi.
The real stuff. Equities, bonds.
So we have reports talking about a major milestone, Chainlink bringing real-time U.S. stock and ETF prices on-chain. Now, playing devil's advocate here, haven't we had synthetic stocks in DeFi for years?
We have, but the difference is latency and liability. The old synthetics were often based on delayed data or centralized feeds that could be manipulated.
And if you're settling a billion-dollar trade,
you cannot use data that is 30 seconds old. In 30 seconds, high-frequency traders have already eaten your lunch. You've been arbitraged to death.
Right.
What Chainlink is doing now is bringing streaming, institutional-grade data, the kind you see on a Bloomberg terminal, directly onto the blockchain. It allows for what they call atomic settlement.
Atomic settlement. Sounds explosive.
It just means it's instant. The trade and the settlement happen at the exact same moment. No more waiting 2 days for the cash to clear.
And banks are actually using this. I mean, we see names like Swift, JP Morgan, UBS in the reports. Is it just press releases or is it real business?
It's moving past the press release phase. BNY Mellon, for instance, is using these Chainlink environments to test their tokenization workflows.
Their digital asset sandbox.
Right. But there has always been one massive roadblock for these banks. And it's not the tech. It's the law.
Compliance.
Always compliance. A bank literally cannot send money to a wallet address if they don't know who owns it. It's a violation of sanctions laws. People go to jail for that.
Which brings us to my favorite acronym in the stack, ACE, the Automated Compliance Engine.
Launching this year, 2026.
So paint me a picture. I'm a compliance officer at a bank. Before ACE, what did I have to do to send $50 million to a counterparty?
Before ACE, you were emailing spreadsheets, calling the other bank, manually checking blacklists, and just, praying the wallet wasn't linked to some hacker group. It was slow and terrifying.
And with ACE?
With ACE, the compliance is baked right into the smart contract. The code itself uses an oracle to check Chainalysis data, the Know Your Transaction tools, before any money ever moves.
So if the wallet is flagged,
the transaction just fails automatically. The code says no. It turns compliance from this manual roadblock into an automated checkpoint.
And that's what finally lets the lawyers sign off.
That's the key. And we're seeing the first signs of that. I noticed a mention of the Cyber Hornet ETF filing, the S&P Crypto 10 EPF.
Love the name. It includes a 0.3% allocation to Link. Now that sounds tiny. A dusting. Why should we care?
No, look at the percentage. Look at the wrapper. It's an ETF. It means LNCAC is being bundled into a regulated investment product that sits next to Bitcoin and Ethereum.
It's no longer just for crypto natives.
Exactly. It's becoming part of a diversified portfolio for people who will never own a Ledger wallet, but do have a 401k.
Okay, I want to pivot to the science part of this.
Yeah.
Because we can talk about banks and tech all day, but does this actually make money for the projects using it? The so what question.
Right.
We have this NBER working paper. And like I said, I tried to read it. I think I got through about 4 pages before the calculus kicked in and my eyes glazed over. But you read the whole thing. What's the headline?
The headline is that oracles print money.
Okay. Elaborate on that.
Well, they analyzed protocols that integrated these decentralized oracle networks and compared them to ones that didn't. And the findings were stark. The protocols that integrated saw 33% higher total value locked, TVL, in the first month.
That's a nice bump.
But wait, after 1 year, that gap widens to 82% higher TVL.
82%. So you get nearly double the growth just by plugging into an oracle.
It makes sense if you think about it. If you can bring in outside data weather, sports scores, stock prices, you can just offer more complex products, options, futures, insurance.
And if you don't have an oracle, you're just stuck swapping tokens.
Pretty much. But the paper also looked at the crashes, specifically the Terra Luna implosion in 2022.
This is my favorite part.
Me too. They found that the integrated protocols recovered faster from the crash.
Which sounds completely counterintuitive. You'd think if everything is connected, when one thing breaks, everything breaks with it. Contagion.
You would think so. But the paper argues for a symbiotic gain. Think of the Oracle network as a smoke detector.
Okay.
In the Terra crash, prices were plummeting. The protocols that relied on slow, centralized price feeds didn't know the price had crashed until it was way too late. They ended up with bad debt.
The house had already burned down.
Exactly. But the protocols using Chainlink got the price updates block by block. They liquidated the bad positions instantly. They took a hit, sure, but they survived because they had the speed of truth.
So it's not just about making more money. It's about not dying.
Survival of the fittest, yeah. And Chainlink just dominates this space. The paper notes they secure over 50% of the total market TVL. So when economists talk about financial integration in crypto, they are basically just talking about Chainlink.
Okay, that brings me to the bear case. Because I have to ask, I'm looking at the chart, I'm looking at the community sentiment on Reddit, and people are frustrated. They're saying, if this is the backbone of the entire financial system, why has the price been stuck between $12 and $16 for what feels like forever?
It's the infrastructure paradox.
Is that a real term, or did you just make that up?
It's real enough. Think about Amazon in the early 2000s. They were building fulfillment centers, cloud servers, logistics. It was expensive, it was boring, and the stock price was flat for a long, long time.
While other dot-coms were flying.
And then crashing.
Right.
Infrastructure takes time to monetize, and there is a legitimate critique here about the tokenomics.
Let's hear it.
The value capture is still indirect. If you hold Link, you aren't getting a dividend check from Swift. You're staking to secure the network. The staking yields right now are under 5%.
Yeah, which is fine.
It's fine. But in crypto, where people are chasing 1,000% yields on meme coins, 5% is boring. It's basically a utility bond.
Right. And we should clarify what the token actually is. We mentioned that MiCA filing earlier.
The European regulations, yeah. LCX filed that white paper.
And they classified Link as a utility token. They highlighted that it uses the ERC 677 standard. We kind of glossed over that. What's the difference?
Okay, think of a standard ERC20 token, like a dollar bill you want to put in a vending machine. You have to do two things. First, you approve the machine to take your money. Then you push the button to buy the soda. 2 transactions. 2 gas fees.
Annoying.
ERC 677 is the vending machine that just works. You put the bill in, and the soda drops. One motion. It's called transfer and call. You send the token, and that same action triggers the data request.
So it's about efficiency.
It's essential for high-frequency automation. If banks had to sign 2 transactions for every single trade, the whole system would grind to a halt.
So the utility is real. The adoption is real. But the moonshot price action is suppressed because it's just boring old infrastructure.
And because of the scale of the transition, we're still waiting for the banks to move from the sandbox to the main stage. That's what the Genius Act is all about.
Sergey Nazarov, Chainlink's founder, has been talking about that a lot. It was signed last summer, July 2025. It regulates stablecoins.
Right. It gave the U.S. a federal definition for a digital dollar. And Nazarov's view is that you can't tokenize real estate or bonds until you have a regulated digital currency to buy them with.
So the stablecoin is the cash.
And Chainlink provides the shopping cart, exactly. The Genius Act provided the cash. Now the shopping spree can finally start.
But there is one more risk we have to mention, the centralization risk. The NBER paper pointed this out too.
Yes. While the network of nodes is decentralized, the actual core development is still heavily driven by Chainlink Labs.
So if the team decides to pack up and move to an island, the road stopped getting paved.
Development would stall, yeah. It's a common issue in crypto, but for something aiming to be a global standard, it's a single point of failure that institutions will want to see diluted over time.
So let's bring it all home. We're in 2026. We've moved from the crypto casino to the financial backbone. We have privacy with confidential compute, compliance with ACE, and interoperability with CCIP.
The convergence is here. The line between DeFi and TradFi is just gone. It's all becoming just finance, a global interconnected system running 24/7.
It feels like the plumbing is finally finished, and they're about to turn on the high-pressure water.
I think that's a good way to put it. And, I want to leave you with a provocative thought on all this.
Go for it.
We spent the last decade celebrating the transparency of the blockchain, this idea that everything is public, verifiable, on-chain. But as Chainlink introduces confidential compute to bring these massive banks on board, are we entering an era where the most valuable smart contracts are actually the ones we can't see?
The invisible economy. That is definitely something to chew on. Thanks for diving deep with us today. We'll catch you on the next one.